Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not so average financial advisor, all of my burning finance questions. And yes, this is my real dad. Let's talk about banking. We're going to talk about everything you need to know so that you can make the most out of your banking experience. So let's start really simple. How do banks work?
Okay, in simplest terms, a bank has a couple of different parties. The first is the depositor. That's the person who puts money into the bank, who deposits money into the bank. The second is the borrower. That's the person who borrows money from a bank for a house, for a car,
Like a
whatever
loan?
their purpose. A loan. Takes a loan from the bank. Company, business loan, okay? And the way that this basically works is the bank pays the depositor. Let's say that the bank pays the depositor 1% to put money into the bank. Then the bank takes that money and loans it out to the borrower, let's say at 5 or 6% or 7%, whatever it is.
Okay.
So there's a difference between the interest rate, what they pay, and the rate at which they loan the money out. And that difference is called a spread. Okay? So with that difference, technically, they would be trying to make their operations, pay for all of their expenses, all their employees, et cetera, et cetera, et cetera. That's in very simple terms how it has always worked since the beginning of time with banks. Things have changed somewhat in that the borrowers, often today, whatever the loan is that's put out there, the bank doesn't any longer hold that, meaning someone else purchases from the bank that debt that those people owe them. So mortgages, for example, Fannie Mae and Freddie Mac are two governmental type organizations. They purchase these pools of these mortgages and they put them out to the public marketplace for people to invest in and earn the interest on them, okay? So the bank now doesn't hold that mortgage debt, let's say, on a house. Now Fannie Mae and Freddie Mac hold that. And the bank now gets its money back, in effect, and can reloan it to someone else. They can put it out now to another borrower. So it's a little more transactional now, rather than where they're just making that spread and holding on to everything.
So let me just clarify to make sure I'm understanding correctly. So a federal organization puts money into what would have been the debt of the loan through a borrower.
That's
and that way the bank is kind of like leveled out.
Yeah, the bank is out of the picture in terms of that loan. They sell it, and it's no longer something that they are generating the interest income on.
I see.
And so, and typically what happens is they're selling it at a price where they're making a profit on it. And then Fannie Mae and Freddie Mac basically take that and sell it. They put it together with a whole bunch of other mortgages, and then people invest in that in the public investment marketplaces. So it's a very common way for people to generate retirement income is to invest in mortgages on houses.
So we've kind of talked about how banks cover their expenses. I'm also wondering, how does the Federal Reserve play into all of this?
Well, what I didn't mention in that little bit about depositors and borrowers is that the bank doesn't loan out fully money from the depositors to those people who are borrowing the money. What the bank really does is it takes a portion of that money, and then it also borrows money from the Federal Reserve, which is the national bank in effect for this purpose. They borrow it from there. So between those two sources, they get the money that they need to make the loan out to the company, the mortgage, the car loan, whatever it is. So the Federal Reserve loans money, interbank, between the banks and all, okay? Number one. Number two, the Federal Reserve manages interest rates in the economy by changing the price at which it makes these loans to the bank, the interest rate at which it makes these loans to the banks. So they can raise interest rates for banks to borrow, and that means that the banks, to make the same amount of money, they have to raise the interest rates that they charge for their mortgage, their car loan, or their corporate loan. So the Federal Reserve is integrally involved in setting interest rates for the country, and those interest rates drive, to a certain degree, economic growth or recession, inflation or not inflation, etc. So that's when we hear at times that the Fed is trying to, say, reduce inflation. Raising interest rates is designed to reduce economic activity, because the more money costs, okay, the less people are able to go out and spend and invest or use that money for something, to get a car or a house, okay? So that reduces economic activity, and that typically slows the economy, which typically slows inflation. So when you hear, there's
it's all
inflation,
coming from the
Federal Reserve, that's basically what they're doing.
Wow. Going back down to the smaller banking level, if I want to start a bank account, really basic, what are the different types of accounts that I could open?
Well, the simplest thing you would open is a savings account, which is just where you put money in and it just earns an interest rate, and you typically are going to leave it there and let it grow, and the bank can use those funds directly to loan out to other people. The second, what's that?
That's wild.
Yeah. Well, that's how a bank works.
I know. I feel like in my head I'm still picturing vaults and Western and someone going into a bank and stealing the money, and it's like someone's actual money.
Well, if you think about a movie like It's a Wonderful Life, right? All of a sudden there was a run on the bank. People weren't paying back their loans, let's say, or there's some of the deposits are missing, or have been lost for some reason. People are afraid if the bank were to go under, they'd lose their money. Now, that doesn't happen today because of something called the FDIC, the Federal Deposit Insurance Corporation. So the federal government, has insurance basically on those deposits, so that people that put money into the banks, they don't have to worry if the bank goes out of business. The federal government, up to $250,000 per account, will protect your money in a bank.
Okay.
So you can have a savings account. You can have a checking account. A checking account is one where you'd be paying bills out of on a regular basis, either a physical check or, more likely today, online bill pay of some kind. The third kind of thing you can do at a bank is something called a certificate of deposit, which is a short-term investment, basically. It's typically less than maybe 3-year time window that you're investing. Not to get too deeply into that, but you're giving the bank the use of the money for a period of time. And it's the same thing. They're going to go out and loan the money out. But you can get a higher interest rate on your money if you agree to say, I won't take it back for at least 2 years, versus your checking account or your savings account, where immediately you can take that money out anytime you want to. So you don't get paid as high an interest rate for that money as you do, say, for money that you lock up for 2 years with the bank. Another possibility is something called a money market account, it's slightly different. It's really more of an investment, and it doesn't quite count in the same way towards money that can be used to loan out, the way that a checking bank account or savings account or certificate of deposit.
So does that mean they have less access to it?
It doesn't count as, to my knowledge, it does not count as the assets they can use to loan.
Okay.
Because what it really is it's a mutual fund that has a lot of shorter term investments within it to try to generate a little higher interest rate than you can get. It's sort of between a certificate of deposit and a checking account or a bank account, savings account. So you can get a little higher interest than that in a money market account. But it may not be government guaranteed. It doesn't have that same federal insurance guarantee that the other things do. It's really a mutual fund. It's a kind of mutual fund.
Something I'm curious about that we've briefly mentioned in other videos is loans. How to apply for one, how to pay one back, how does it actually work within the banking system? Okay.
Well, as we've said in a couple of the other videos, the thing that the bank is concerned about is, are you going to pay it back, right?
Yeah.
Whatever you borrow, because if you don't pay it back, the bank takes a loss, basically, for that amount of money, which no business likes to take a loss if they can avoid taking a loss. So what the bank's going to look at is, what is the purpose? What are you trying to do with this money? Number one, for example, in business, if you're trying to borrow money for different kinds of purposes, they might or might not be interested in loaning it to you. If you're trying to buy some equipment, they might be willing to loan it to you. But if you're just trying to stave off bankruptcy because things aren't going well, they may not want to loan it to you no matter what's going right. So what's the purpose of the money? Why are you trying to borrow the money? Second thing is going to be, does your cash flow, meaning your income or your business profits, okay, will that cover the payments to pay the loan back by enough money? It's very similar to the concept of income verification. Do you have enough income so that they can feel comfortable that you're going to be able to pay that back from the way things are going in terms of cash flow? And the third thing gets back to credit history. Do you have a history of paying back the debts that you owe, or have you, not paid some money back or been very late in your payments and things like that? And because all of those things play into, will we get paid back? Will we get paid back on the money? And so they're going to be looking at those things. They're going to have you fill out a lot of paperwork. That, of course,
Great.
You sign away your life basically.
Yeah.
And in many instances, even though you might be borrowing money, let's say for a car, they may have you responsible for using money that's not in the car to pay back the loan for the car. So you might be responsible beyond just the car itself or the house itself or the business itself. And that's called a personal guarantee, where you're on the line.
It's like collateral.
The collateral is you and your ability to earn money or pay money if it's a personal guarantee. So in business, there were many times when I had to sign a personal guarantee to, for example, lease out an office space or something like that, which meant that even if I'm not supposed to have to pay for that personally, if the company's not able to, they're going to come to me personally and ask me to pay for it. So it's not fun.
No,
that's not fun.
But very interesting.
But that's how banks protect themselves against, especially if there is some risk as they see it in the process. But so you fill out the paperwork, and then this goes to what's called an underwriter, and the underwriter looks at it, looks at the situation, gathers more information if needed, and determines whether or not they think the bank can take this risk. And they typically have committees at banks where this would be presented to the committee for them to decide whether or not they are comfortable with it also. It's usually upper management people. And because the bank doesn't let any one person make all the decisions, typically it's usual decision by committee kind of thing. Okay. And then, if they approve it, you'll get your loan, you get your money. And then now you got to start paying it back almost immediately, typically. Usually, they're either going to bill you and you send a check or an online payment to them, or more likely, they're going to ask to deduct it directly from a checking account somewhere so that they feel a little more strongly that they're going to get paid their money and on time.
Yeah. Is it normally a monthly payment for a loan, or is there a different way to set it up?
It's normally a monthly payment for loans. Yep.
Okay. Well, great. That is everything for this episode on banking, and we hope that you feel prepared to open and manage your own accounts. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website, and make sure to click on to the next.